Welcome to FXtech's comprehensive USD/CAD analysis for the week of October 27th to November 1st, 2025. This week proved pivotal for the currency pair as central bank decisions from both the Federal Reserve and Bank of Canada shaped market dynamics. USD/CAD closed the week at 1.4000, representing a 0.64% gain from the previous week's close of 1.3911. The pair traded in a range between 1.3886 and 1.4050, demonstrating significant intra-week volatility. This movement reflects the market's reaction to central bank policy announcements and shifting interest rate expectations. The technical picture remains constructive, with the pair holding above its 55-day exponential moving average at 1.3914, a critical support level. Immediate resistance stands at 1.4078, which represents the 50% retracement of the decline from 1.4791 to 1.3538. A break above this level would target 1.4104, the 38.2% retracement. The broader rising channel structure remains intact, suggesting the uptrend from September's low continues to develop. Market sentiment shifted notably hawkish following Fed commentary. USD/CAD closed the week at 1.4000, representing a 0.64% gain from the previous week's close of 1.3911. The pair traded in a range between 1.3886 and 1.4050, demonstrating significant intra-week volatility. This movement reflects the market's reaction to central bank policy announcements and shifting interest rate expectations. The technical picture remains constructive, with the pair holding above its 55-day exponential moving average at 1.3914, a critical support level. Immediate resistance stands at 1.4078, which represents the 50% retracement of the decline from 1.4791 to 1.3538. A break above this level would target 1.4104, the 38.2% retracement. The broader rising channel structure remains intact, suggesting the uptrend from September's low continues to develop. Market sentiment shifted notably hawkish following Fed commentary. The technical structure of USD/CAD remains firmly bullish across multiple timeframes. The pair continues trading within its rising channel, well above the 55-day exponential moving average at 1.3914, which has provided reliable support throughout October. The uptrend from the 1.3538 low represents the second leg of a corrective pattern from the 1.4791 high. Key resistance levels are clearly defined. 1.4078 marks the immediate hurdle, followed by 1.4104 and the psychological 1.4250 level. Support is equally well established at 1.3887, with critical support at 1.3725. A break below 1.3725 would invalidate the current uptrend structure. Momentum indicators show no signs of channel breakdown, with pullbacks consistently finding buyers at lower channel boundaries. The long-term uptrend from the 2007 low of 0.90567 remains intact, supported by the 55-month EMA at 1.3525. This week's central bank meetings proved decisive for USD/CAD direction. The Federal Reserve delivered a widely expected 25 basis point rate cut, but surprised markets with hawkish forward guidance, stating that a December rate cut is not necessarily guaranteed. This represented a significant shift from previous dovish expectations and provided immediate support to the US dollar. The Fed described economic recovery as moderate but highlighted persistent weak spots and trade policy risks. Meanwhile, the Bank of Canada held its key rate at 0.5% for a fifth consecutive meeting, matching market expectations. The BOC approved plans to begin selling ETFs and JREITs from its portfolio, signaling gradual policy normalization. both central banks acknowledged moderate economic recovery, but expressed concerns about global trade policy impacts. The widening interest rate differential favors USD strength. The week's price action unfolded in three distinct phases. Phase 1, spanning Monday through Tuesday, saw profit-taking ahead of central bank meetings, with USD/CAD declining from 1.3950 to 1.3886. Traders positioned for a potentially dovish Fed pivot, creating technical selling pressure near overbought levels. Phase 2, Wednesday through Thursday, witnessed a sharp reversal as the Fed's hawkish stance caught markets off guard. The pair surged from 1.3886 back above 1.4050, driven by reassessment of U.S. interest rate expectations and broad-based dollar strength. The weak CAD response to the BOC decision amplified the move. Phase 3, Friday's session, brought consolidation around the 1.4000 psychological level as markets digested the week's events and traders positioned ahead of the weekend. This three-phase pattern reflects the market's adjustment to shifting central bank narratives. Our outlook remains constructive across all timeframes with varying degrees of conviction. Short-term, we maintain an upward bias targeting 1.4078 initially, with extension toward 1.4250 possible. The technical structure supports buying on pullbacks toward 1.3914 to 1.3887, with the 55-day EMA providing reliable support. Medium term, we expect range-bound trading between 1.3725 and 1.4250 as markets digest central bank policies. The corrective pattern from 1.4791 continues, with 1.3725 support critical. A break would invalidate the uptrend. We assign 45% probability to range-bound action, 35% to bullish breakout, and 20% to bearish correction. Long-term, the bullish structure from 2007 remains intact with 55-month EMA support at 1.3525. We favor a 60% probability of continued range-bound trading between 1.3500 to 1.4800, with scenarios for both bullish extension and bearish reversal. Risk assessment requires balanced consideration of factors favoring both USD/CAD strength and weakness. Upside risks include continued Fed hawkishness, U.S. economic outperformance, oil price weakness, BOC dovish pivot, risk-off environment favoring the dollar, and Canadian economic disappointment. These factors could drive the pair toward 1.4250 to 1.4500. Downside risks encompass Fed dovish surprise, oil price surge, U.S. economic weakness, BOC hawkish shift, technical breakdown below 1.3725, and trade policy improvements benefiting Canada. Such developments could pressure the pair toward 1.3500 to 1.3900. Our probability assessment for the next 1 to 3 months assigns 35% to bullish breakout above 1.4250, 45% to range-bound consolidation between 1.3900 to 1.4200, and 20% to bearish correction toward 1.3500 to 1.3900. The most likely scenario remains consolidation as markets balance competing forces.